Cypress Ridge webinar. It's Kevin here. Sitting next to me is Michiel in Cape Town at the moment. And online we also have Willie up in Centurion. Good evening, guys.
How's it, Kevin?
Good. Before we start, just some quick. How's it, Brian? Some quick things. Please, I ask that you use the question box. Brian has been a good example, saying good evening to us. It's really great when we have a webinar to have interaction. So please use the question box to ask questions. It's not going to be too long tonight. We're going to show you the opportunity we have. And so we'll hand over to Michiel and Willie, who are going to take us through the presentation. Okay, Michiel, over to you.
Thanks, Kevin. Welcome to everybody. Thanks for joining us. We're going to start off just a brief outline on what opportunities we're looking at in the United States and why. So we're just going to start with a bigger why in the first instance, and then very specifically we're going to delve into the actual opportunity, and then also at the end we're going to just show what we've been busy with and what is coming in the short-term future. So yeah, to that extent, Kevin, let's go for it. All right, so for those that have seen it before, just bear with us. I think it's very important that we all understand why we're doing it. So the first situation is pretty much if you in your own mind just came to the conclusion that you would like to have exposure in the United States. We from Wealth Migrate has been going through the global due diligence phase. We looked at 16 countries and effectively came down to the United States, the UK and Australia at the moment, and we're actively focusing on on America and the Australia side of things. We're a little bit cautious on the UK, etc. So the first step that we are saying is we're very clear that both United States and Australia for us has currently got value. And then in the United States, we're basically saying which of these states are we focusing on, and I'm going to take you through the reasoning in those specific states. So the first thing that we have done is we've really identified top-down which states we want to be, and what I'm going to outline now is the reasoning behind it and how did we build up to the areas that we're looking at. Then once we have looked at the areas that we want to look at, we are going to look at the specific sectors that we want to deal with. And once we know the specific sectors, we will go into the specific opportunity. So the first thing that we've seen is that there's a remarkable shift in our business practices, which means that airports are becoming more important than ports. So from that perspective, the advent of the whole online business has made it extremely necessary to be around logistical hubs, and one of the most important hubs that we have identified, and this comes from the research on the MIPIM conferences that we've been have been part of, and the research and the collective feedback that we got is that airports is becoming more important than ports, and therefore as you can see on these slides, the two that obviously stands out for us is pretty much the number one, which is the Atlanta airport. Currently it's viewed as the most busy airport in the world. So from that perspective, to give you some insights to that, is that we also find that that drives a lot of logistics, and it also fuels a lot of tourism, and it also fuels a lot of locations of business headquarters. So these are the driving factors. All of these factors obviously adds to population growth, and population growth adds directly correlated to property investment returns. The second area, you can see varied different amount of, let's call it most travel airports around the United States. The second place that we're very comfortable with is the number 4, which is the Texas side of things. You can see California is also pretty busy. and then Chicago there around about number 2 in the middle. So these are pretty much the busiest airports. So that's the first criteria that we looked at. The second that we looked at is the landlord-friendly states. What that effectively means is that we would like to ensure that our rights as landlords are protected. And as you know, Wealth Migrate's first principle is wealth protection. So from that perspective, it's very important that we know that our rights are protected, going into a state which favors more the tenants than the landlords. Examples of favoring the tenants is currently New York, or New York State, or Pennsylvania is a good example of it, where tenants has a right, and in some extreme cases where tenants has actually occupied buildings, and like in South Africa or other parts of the world, the landlords not necessarily can get them out. They have to actually go through a very lengthy process, and this lengthy process obviously costs a lot of money. So what we see is in the landlord-friendly states is a very efficient system to protect the rights of the landlords. The next criteria that we're obviously looking at is where is the highest growth. In terms of highest growth, we are measuring it in terms of population growth, and in this specific case we've looked at state growth, and we also looked at city growth. City growth is not so visible in this specific case, but most of the cities that we are looking at are effectively in the top 20 cities in terms of population growth, sustained over the last 5 years with projected into the next 5 years. So it's not a question that we want to look at the fly-by-nights or the flash in the pans. We want to look at cities that has got consistently the highest growth. And Atlanta, the whole Texas, and very interesting, the North Carolinas has been very key on our radar, as well as Florida. And as you can see, they pretty much are in the focus area. The next major consideration that we're looking at is that it's absolutely clear to us that Texas is by far the fastest growing market, and it also has most of the fastest growing cities in the United States consistently on the top 20 of fastest growing cities. So from that perspective, we would like to focus on what we call the Texaplex. It's also quite a well-known phenomenon, is that 80% of the people in Texas actually live in this triangle. The triangle is actually made up by Dallas, Austin, and Houston. We're also including a little bit San Antonio for that matter. So these cities are pretty much driving the growth in this area. Houston has been very dominant from a oil production, a refinery production, and we'll go into that a little bit in detail just now. Austin is the headquarters of Texas. San Antonio is pretty much one of the biggest military bases in the United States. There's 5 military bases there, and Dallas-Fort Worth. If you maybe, Kevin, if you can just point out to Dallas-Fort Worth there on the screen, you will see that a lot of people are talking about Dallas-Fort Worth. It's actually 2 cities that's just really grown together because of the huge conglomerate that's really happening there. So, so that is the Texas market, and it's by far one of the strongest growth areas. So if you then consolidate these factors together, we have pretty much came to the conclusion that from our perspective, we would like to focus on these 2 areas highlighted in the yellow circles. The one exposure is very clearly the Texas exposure. The other exposure is pretty much the Georgia, Florida, Alabama, North Carolina, South Carolina exposure into also Tennessee, which is the R8 there. And yeah, so this is our primary focus. It's not to say that we will not do work in other states, but what we have seen from the first principle up, this is pretty much the areas that we want to go in. So once we more or less know how to work in this absolute vast country, America is just unbelievably big. We have to narrow it down, and that's our focus for the moment. And then based on that, we then obviously have the next natural question is then, which of the commercial segments do we actually want to focus in? So from that perspective, we are going to tonight specifically discuss the multifamily focus. And I think what's important to do is just to explain the segment a little bit to show you what a multifamily is. So what the multifamily is a single title, multiple living unit complex. It's the equivalent in South Africa as a block of flats. That basically means it's not a sectional title. The equivalent of a sectional title in the United States is called condominiums, and it's just like South Africa. Each condominium has its own sectional title with a common area. In the single family methodology, we are basically looking specifically at one title, single management, and normally when it's more than 4 units, it's considered as commercial real estate assets. That basically means it changes from residential to commercial grade asset. And in this specific case, the multifamilies that is pretty much, let's call it more than 100 units, also really becomes institutional grade assets. So from that perspective, we have this as a multifamily. The multifamily obviously comes in lots of shapes and sizes. It comes also as we know it, the stack simplexes, or actually the duplexes. So we have cases where it is not double stories. We also have cases where it's actually a very high-rise amount of flats just on top of each other, let's say 8 stories high. So it really comes in all shapes and sizes. I think the absolute key consideration in these units are the attractiveness of the stabilized income that is derived from these units. So what we found, and this is pretty much what investors is finding, is that once the units are let up, the occupancy typically is a very diversified income. So let's take an example of 250 units. If you lose 50 tenants, it's not as bad as if you would have had a single house and you would have lost the income of a single house, which means you lost 100% of your income. So it means that the predictability of the income from these multifamilies are very high, and there's a lot of things that you can do to maintain the occupancy to a certain level, and that's the attractiveness. And this is the market segment that we want to discuss tonight. Let's go to the next slide. So when we look at the national cap rates, we have been talking a lot about the medical office space. So Kevin, if you just click one more time, I think there should come a little circle. Just go back once. Just highlight the medical office space there, pretty much 16, yeah. As you can see, this is a sector that we've been focusing on. The medical office space has been very significantly been still the #1 favorite market segment in the United States from a commercial real estate perspective. It's on the Piper report, for those that knows it. The Piper report just recently came out 2016, and through us nuts, it reconfirmed what has been said in 2014, 2015, and 2016, that medical office space. The second area, which is obviously not yet on this graph, is the multifamily. And then the third area, Kevin, if we can maybe just show the last one in the row, is the self-storage. The self-storage is the third segment, which is extremely active. You can effectively think of a self-storage as a multifamily without people, because you're just storing the actual equipment, but it's got the same functionality as a multifamily. So from Wealth Migrate perspective, we have very clearly are doing medical, and we will continue with that. But the aim of tonight is to show you that we are really focusing in also on the additional Second segment in the market, which has been an absolute investor favorite, which is the multifamily. So when we go to the next slide, as you know, the moment the capitalization rates means that effectively it means that the lower the rate is, the more expensive the properties become. You can see the inverse trend is very clearly here, that it's really becoming a very hot commodity. The cap rates of certain aspects of the multifamilies are, can you see in the slide, is below 5%. It means the cap rate is below 5%. And if you can still buy a unit with a cap rate above 7%, Kevin, if you maybe just show 2015 above the 7% mark on the right-hand side of the curve, you can see above that orange line, if you can still buy in that region, the market has already moved down pretty much below 6% cap rate, which basically means that if you can buy at 7%, you have the opportunity to add value and then potentially sell the units. And that's really the opportunity. The danger of this is that it's becoming very expensive. It means that the lower the cap rate, the more expensive the units are, and you as an investor have to be very careful, and this is where Wealth Migrate is focusing on, that we're not paying too much for the units. So from that perspective, it clearly shows where we are on that graph. So on the next graph, Willie, maybe you can add a little bit in terms of what the other key trend that has been driving the multifamily sector.
Yes, evening guys and ladies. If we look at this graph, you'll note it is actually from 1994 that the statistics have been drawn from. And you'll note that the under 35 percentage of home owners are actually around 34%, which is far less than the average of 63% for the past couple of years. The main reason for that is what they call the generation of millennials. These guys are basically, they grew up during the Great Recession time. They saw their parents struggling with mortgages, and houses value depreciate to such an extent that it went underwater. So for that reason, we are seeing that these guys are only willing to participate in home ownership when they're really secure. And I think to a certain extent it is more your white-collar workers that will probably make up those numbers, because as Michiel already made mention to it, it's not just in the multifamily space where we find that the housing prices are quite expensive, but it's also on the single-family units as well, which is also enhancing this statistic to move lower as the home ownership just becomes unaffordable, because also of the substantial deposits that people need to put down to purchase a house, and that's why the statistics is driving lower, because it just becomes more expensive to buy into these not just multifamily is something different, but in single family units. So I think if you go to the next slide, there's also the population of millennials, which makes up, I think, sorry, Kevin, if you just can move to the next one. You can see there the population, one back, sorry. The population after 20 to 34 years old will be in the region of 66 million people in America over the course of the next 10 years. Which again places a new stretch on the home supply. And what we also seen, unfortunately, we've not, I've not got a graph indicating that, but as you well know, is that from the Great Recession there was a lot of homes not being built, and statistics from the Fannie Mae report that we worked through just a couple of weeks ago also emphasized the point that even though we've seen some new developments taking place after the Great Recession, the amount of starts is still 30% below the 1970 to 2007 average. It's still 30% lower than that. And as you can see from this graph of the population under the 20 to 34-year-olds, it'll actually mean that there's still going to be a shortage of homes with the current starts, and that's what makes this also quite a beautiful market, is because of the guys just wanting to rent rather than owning a home. And to the right here, the graph is just basically summarized the whole generations together. And as you can see, from 2006, it's progressively still continuing lower below the long-term average. If we continue to the next slide, this market as well is driven also by employment. And as you can see from the graph, is that unemployment rate has been decreasing over the last couple of years since the Great Recession, and jobs are continuing being added. This is basically positive as well from a rental perspective, and this makes it a far more attractive, because what the statistics is not showing on the graph there, but the guys, the millennials, the unemployment rate was 12% in 2008, and it's now down to 4.7%, which means these guys have got the bucks to rent. And as you can see, due to the shortage of homes, it drives up the average rental prices as well. And from the graph, you can see year on year, it's about 3%, and that's way above the inflation rate. And that's also what makes this market so attractive. It sort of buffers you against the interest rate hikes, as Michael also alluded to. With the cap rates being so low, there's still room versus your 10-year yield that the bond yield that you can pay, which is around 2%.
I just want to ask you, these statistics, are they specifically to Texas? Do you see that these statistics are more focused in Texas, or more emphasized, or how do you see it compared to the other states?
Well, yeah, these numbers are actually it's nationally, but if we look at the rental growth statistically for Houston, it's been averaging between 7%, 7 to 6. It's been going down a bit with the new absorption coming on, but it's still substantially higher than what the national average you are seeing here with regards to the rental increases. The Texas market as well, and Houston specific, there's a lot of jobs being added because of the not just landlord-friendly state, but also tax-beneficial states. Houston specific has a couple of programs attracting Forbes 500 companies. I think Google has got and JP Morgan. Who is there else that's moving? I think it's 23. I can't recall now, Michael, if we can just come in here, but I think it's around 500 top 500 companies that they are moving to Texas, and specifically US, not US, sorry, excuse me, to Houston. That's in the energy space because of the preferential tax that they get there. It's actually, I think, if I'm correct, it's zero tax that they get to pay.
Yeah, one of the attraction why Texas at the moment so attractive to everybody is that there's a zero tax rate for corporations that are founded in Texas. Just to give everybody an indication, is that the average home price in Texas is around $450,000, compared to about $700,000 plus in the Greater California area, and compared to $1 million in the New York, Boston area. So it basically means that people pay less tax in there, although the property tax is a little bit higher, but the attractiveness is there. The second major driver is that it's an at-will state. That basically means you have the freedom to scale your workforce depending on your business needs, which makes it a flexible workspace. And then the third space, which really is pushing the envelope for doctors, is the fact that the medical malpractice insurance are capped in the state of Texas. So as a result, the biggest burning research centers is in San Antonio, and by far the biggest concentration of medical research is actually in Houston. And then I think lastly, with related to Houston, really I think it was very important for us to also understand what is the influence of oil on Houston. We all know that the oil price has been substantially subdued since the $100. And then I think we've really looked at that in detail. And really I think we came out that the dependence is in the region of 40% of the GDP of Houston at the moment.
That is correct, Michiel. One of the things that people actually don't know about Houston, it's actually rated as the #1 manufacturing city in the US as well. It just defines that since the dependence, since some of the oil crisis that they've experienced in the past, they've really worked hard to diversify the whole GDP. What's also good to know is that the port of Houston is internationally one of the biggest ports and actually handles around 220 million tons of domestic and foreign cargo. That's basically 10th largest port in the world, which also makes it, the medical center itself is also, I think, contributing around just 10 billion to the GDP every year, just from the medical center space. So the market is quite diversified, and it's not just oil anymore, but it's manufacturing, exporting, and then medical research that is really sustaining this Houston economy.
Yeah, and then the other segment that I think everybody knows from the space program, the Houston Control Center is there, and we'll get into that just now. So really, me and you both had the privilege to actually be at this unit. So we basically both visit the unit. So as true to our principles, we do not offer investments which we do not actually visit. You had the time to do it itself, so maybe just take us through high level the deal, and then I think just quickly do that, and let's focus then on the location of where in Houston it is. I think that's quite insightful for a lot of people.
Okay. Yes. Yeah. So yeah, it is a well located 252 multifamily units. It consists of 1, 2, and 3 bedroom apartments. There's basically what you can see from the picture. There's a swimming pool, gazebo, barbecue facilities, like they call it, and there's also laundry care facilities. I think there's 3. So effectively, what you can see, it's actually a 1980 building, and that's what actually makes it such a value play. Is that from the picture you can't really see it, but the exterior has been newly renovated in the last 2-3 years, which gives us the opportunity to look into renovate the interiors. They've already started renovating 52 units, which means that we're going to actually change another 200 units in over the next 2 to 3 years. Basically, it takes around 2 weeks to turn one of these units over. What basically is going to happen is the kitchen is going to be revamped by remodeling, replacing some of the doors, the handles, appliances. All the appliances are getting renewed. There's going to be cosmetic changes like paint and new carpets, just to get a new homely feel to this property. And in that, currently the vacancy is around 8%. We believe that with the renovations, that will also attract new tenants, and it also gives us the ability to raise the rent to get to an average close to between 4 to 6%. Whilst currently, if you look at the inflation rate, is around just below 1% in America. which actually makes this such an attractive deal. The cap rates projection being around 6.10% over the next 5 years, it will mean that the figures are being quite conservative. We're looking at a hurdle rate of 7%. The IRR of the project for the period of the 4 years will be 19.6%, which I think, if you compare it to some of our previous products in the medical space, it is a bit higher. Main reason for it is basically because we're seeing a bit of extra value play during the course of the 4-year period. As you can see from the slide, the term is 4 years, minimum investment amount will be 10,000, and the deal size is basically 15.7 million. The required equity will be around 5.9. If you do your a bit of maths, you'll note that the loan to value is around 62%. The reason also for that is that we are taking a bit more conservative approach, with some indications being that there could be some interest rates in the near future. There's speculation maybe even tomorrow, but we're quite doubtful about that.
Yeah. I think really, before we go in too much detail further, my suggestion is let's locate the unit here. The unit is located on the northern side of Houston. For those that's not familiar with Houston, this is the equivalent of the N3 ring road in Johannesburg. They've just gone to the extreme of actually having 3 ring roads. The bulk of the white-collar head office locations is on this side. The huge medical research center is on the clock at 6 o'clock, and most of the harbor activities and refinery activities are on the clock 3 o'clock, and the Houston Space Centers are, and all the works are up here pretty much on 1 o'clock, and then the very, very busy Austin International Airport is located here. And then ExxonMobil have just moved their campus here. It's a 40,000 unit campus. People, it's just unbelievable, the size. I mean, it's 40,000 workers coming here, and that's not, that's just the workers, and then the rest of the family is still in this vicinity to live. And then one of the most spectacular and largest gated and planned community centers are the Woodlands. It's actually got 5 signature golf courses. Very interesting. So what you can see is that Cypress Ridge is on the renewal. So it basically means the revival of the city is moving upwards, and we're pretty much on the side of this. And the idea with the PPA group, which is really the specialist in that, is that they are predicting that this urban revival will catch up with this area. They've already seen the impact of that, and the whole idea of this project is to renovate and to ensure that these units are renovated, to ensure that this workforce that is now starting to creep up this direction and expanding, and then coming down from the Woodlands into these areas, are now getting taken care of, and that's the rationale behind the unit. So really, I think that's enough on the location. Maybe take us through the key points, you know, in terms of the actual deal here.
Yeah, sorry, thanks, Michael. I just unmuted myself there. Multifamily, yeah, like I mentioned earlier, I think for us, what we're expecting is not to see an impact on the cap rates, as I just mentioned earlier, is that there's a bit of room between what we're seeing from the average bond yield rates over the next 5 years. I mean, you can only, if you invest in the bonds, get around less than 2% for that, and that's based on that. We can see that there's going to be a bit of movement that can take place with regards to the interest rates before it will catch up to the cap rate of a multifamily units. What we also that Michiel also made mention to is that it's multi-tenanted units, which means there's 252 units that can be rented out, and currently the vacancy is around 8%, which means that it doesn't materially affect your occupancy risk as what you would see with a commercial building where you maybe only are able to put in 10 tenants, and I mean, if 2 or 3 of them gone, it's basically 70%. So there need to be a substantial amount of people moving out before you get that risk. As Michiel also mentioned, this is in a growth area. Woodlands is a master plan development that's close by. We like the state, that's Texas, and as Michiel mentioned, what we also love about Texas is the fact that it's a landlord-friendly state. The value play here is that we can renovate the units. As can see from the brochure, the average units price, the rental price is around $777. If we compare it to the current market value, which is closer to $900, we can renovate this and move it up to what the market value is, and actually make up between 4 and 6%, like I mentioned earlier. This basically allows us to make sure that over the 4-year period time, we optimize the efficiency and the rent roll, which effectively means that at a higher cap rate, we should see around 70% return on your capital that you put in, potentially after tax. One thing to note there is just that the structure, we're only going to make use of the platform, which has got a 10,000 minimal investment requirement. The reason why we're not going to make use of the LLCs this time around is because we are making use of a new lender, or let me rephrase, our partner make use of Fannie Mae, which they've got a good relationship with, and also is got the best returns. So they basically are offering us a 4% fixed interest rate, and because of that, we needed to adhere to the requirements, which unfortunately
really, maybe I can just assure our investors that this is very specifically to the case of Cypress Ridge. Some of the further projects will still allow investors that got the existing LLCs. So it's not the end of the road for LLC, but it's just very specifically to the lender requirements of this deal. So in terms of the returns, Willie?
Yes, if you can go to the next page. Yeah, there we go. It's we're looking at, well, like I mentioned earlier, the hurdle rate is 7%. The first year we're looking at a 7.4% per annum. Second year roughly 8.6%. Then it drops a bit to 7.2%, mainly due to the fact that the first 2 years we're only going to serve interest, and then there's going to be a principal payment. So we were looking at an average just above 8% that should be achievable. Like I already mentioned, the internal rate of return after tax will be 19.6%. The main reason for it is because of the capital growth at the end of the 4-year period that is affording us this beautiful return. The exit strategy will be after the renovation and increased rent roll. We're gonna exit at 4 years. The reason for that is that we and the PPA, well, let me rephrase, the PPA group, they've got over 4,000 units that they've managed before and over the past 17 years, and they found that the sweet spot is around 4 years, and most of the renovations would have also been finished by then, which means that there's not a lot of movement for increasing the value after the 4-year period. Yeah, I think, and then basically we're buying at a very good price. The cap rate is 7.5. 7%, which means it's roughly around $51,000 per door, which is substantially lower than what we're seeing in the market and in the area, as Michiel already mentioned.
Willie, maybe I just want to inject here. What is remarkable about this, as you could see, the cap rates were pretty much already below 7, and just to give you some clout, we can discuss it just now. The partner that we found is as equivalent to what we've been used to on the medical side, and that's the second absolute attractiveness to us. On this deal, there was 20 offers. That means that the PPA group, which was partner, has managed to not only win the 20 guys, but also won it at the 7.6 price, which in our opinion is a fantastic price in the current market area. So that's why you will see also we're pushing hard to close it, because the seller has simply said, if we can't close, I've got more than enough other people that I can show the deal for. So the multifamily market is extremely hot, as was indicated by the cap rates. So the fact that we got this gem at this price is just unbelievable testament to our quality of our partner and their ability to operate in this market.
Yeah, no, for sure. I think just to finish off on that is that we were visiting Houston and looking at the property. Myself and the partner actually looked at around 8 properties during the course of the day. And if we compared the price, the asking price of the other properties against what we were receiving and what they were, the property's condition were at, they were ranging between 65,000 to around 85,000 per door, and the quality was just not as at the same level. So I was quite comfortable in that we're getting a good price, and the interior rehabs is basically not going to be that intensive. And it is actually remarkable that we can do this.
I must say, Willie, I concur. We actually were surprised to the good state of the units. Myself and Scott actually interviewed the property manager. They actually instated the new property manager already, and she's starting to make headwinds. I think I just want to quickly explain the cap rates again for those that doesn't know that. In commercial language, that basically means it's the capitalization rate, which is derived from the net operating income, which basically means after we paid expenses, divide by the purchase price of the property. So what it basically means is we talk about a 6 cap rate compared to a 7.5 cap rate. It means that if we pay a 6 cap rate, the building is much more expensive than a building at 5.7. So as you can see, in this slide, point 12 says we're buying at 5.7, and we 7.57, and we expect to sell at below 6. So that 1.5% is really what we're effectively saying is that we have the potential to have a actual price increase. I just wanted to recap on that, and then we've launched the actual equity raising phase this week by virtue of pledge mode on the actual platform, and we expect on Friday or Monday that we will actually go into the investment mode. It basically means you can actually do the actual transaction to get into this. The most exciting about this development is you might know is that Wealth Migrate has really been focusing on creating partnerships, and the partnerships really is dependent on the quality of the partner. So really, you as a guy that has visited them, secondly after myself and Annie started with them, what were your impressions of the PPA group, and how do you rate them in terms of quality of partner?
Yeah, no, I think I've actually had the good fortune as to meet John Latham, the Chief Investment Officer, and spend the whole day driving from Houston to Austin. So I got I think, a great advantage in getting to know and getting to understand how they're thinking. And yeah, I mean, for me, they definitely rating as our previous partner in Atlanta, maybe even a bit better, because they've got, like you can see on the slide, 120 people staff. They've got their own property management company, development company. Currently, they've already got 400 units that they're also basically developing. So it's not a case that they newbies. They're quite professional, and yeah, they've been in the market for a while, you know. And what you also get when you get to go to the offices is the fact that they have been rated as Inc. 500 company, which is quite a I think an awesome reward to receive, being such a young company, you know. So yeah, and I think it's they are. Yeah, I would love to see more transactions coming from them, because the quality of work is brilliant.
Good. What I would like to do now is have the opportunity, if there's some questions on the deal. The first question that I see currently coming through is from Brian Smith. So the question was really how and where will the dividends be paid if there's not an LLC bank account. Based on our platform, that basically means we have an offshore platform, and on this platform each investor will actually have a wallet, and this wallet is a virtual bank account as part of the platform, and the returns will be paid as dividends into this wallet on the platform. So there would actually be, for investor on the platform, there will actually not be the need to have the actual account, bank account opened, as in the case of an LLC investor. So the whole idea of the platform is to make the investment process as simple as possible. That basically means that Wealth Migrate and the third-party suppliers will do one overall tax return for this unit, and then this overall tax return will then obviously be submitted to the American authorities, and this actual authorities, the actual tax return will be done as part of the investment. So that means that the investor will really be looking only at, once they receive their dividends in their, let's call it wallet on the platform. This wallet will be, it's a basically account that is a non-interest account, and then you have the option to either choose on the platform to reinvest the dividends that you would like to have, and if you opt to then extract the dividends, that dividends will then be returned to your source bank account, which is registered as part of your initial investment process. So it's a very nice way of actually storing money offshore. There's also not a repatriation requirement because it's a trading account, and like I said, there is actually no real interest paid on it, and it's actually not a transactional account. It's really for you to either reinvest or then request it to be paid out to you. However, once a year you will get basically a statement that will show you how much dividends has been paid into the wallet, and this wallet income would actually need to be shown to the tax authorities in a relevant jurisdiction. If you're a South African investor, obviously you will show it there, and then the offshore account will then effectively have your income, and you as a South African or whatever country you're residing in, on that income you have to pay, in this case, dividends tax. So from another question I see here from Denise, but the offshore account is residing in the LLC. Denise, in this specific case, the investment is made on the platform and it's not associated with the actual LLC. I can take you maybe a little bit in more detail on that, but in essence, the LLC is not involved in the investment process in this specific case. Right, so I didn't see any other questions. So from that perspective, I just want to give everybody also a little bit of feedback that the strategy that we have dealt with, where we focus on quality of partners, has really ensured that we've got a fantastic track record. For those that haven't seen that, we've actually created the track record of our past deals. As you know, we started off with the medical properties. We've basically branded it now with our partners. In this specific case, is SG Property deal. So from that perspective, we projected 8.3, and we're consistently keeping that now to the investors up to recently, and we closed that in August 2014. So pretty much it's just gone 2 years now on this deal. So that's very nice. Second one, we closed in March 2015, which is pretty much a year and a bit. This is our best performing asset at the moment. We projected around about 11%, and we're currently maintaining that. And then the one that we did earlier this year, it's keeping 100% on track for the first 2 quarters that we're busy with. So that's on track, and we are going to pay out the dividends pretty much in line with this in October for all the deals that I just mentioned. And then the last one we did on 1st of July is pretty much the Medical 5 deal, and at the moment the first quarter result is going to be happening at the end of this month. So pretty much from our perspective, it's been really going on track. Then for those that don't know, we've basically launched the Kensington on Latham. The first phase and the second phase has been funded in August this year, and we're busy with the last tranche. So anyone that still wants exposure to Australia, we're pretty much on the last $900,000. The project obviously started with the first phase of $3.5 million. We actually bought the land. The developer is now getting ready for construction, and we're pretty much on track to start construction later in October, beginning November. And for those investors that invested on it, we'll pretty much give you an update on the actual program. Then with regards to our future pipeline, we obviously are in progress with our medical story. So our medical deal that's coming out of Texas, we're in the finalization stage of this deal. So we most probably going to launch it pretty much first week in October, second week in October, if all goes well. We're busy with the purchase and sale agreement. Later tonight, we're actually going to do some of the final negotiations. So if all goes well, then this deal will also be launching pretty much later in October. And that's really the deal count that we're busy with currently as we speak. So what I would like to suggest, if you are keen to get interested in this investment, please log into the secure site, pledge your interest. The best thing to do is load up your profile with your KYC documents. It's pretty much your ID and your proof of payment, your proof of address, not older than 3 years, 3 months. And this is pretty much the next step that we're asking you if you're interested to do that. In terms of the platform, this is going to go into investment mode most probably on Friday or Monday, and we are actually on track on focusing to close the deal before we actually get all the money included. So Wealth Migrate is busy with underwriting the deal. If the deal goes ahead and we are successful, then the investments will conclude most probably end of October, midway into November. If we're unable to secure the deal and get finalization on the underwriting fund, of course, the money would simply be returned. So that's where we are on that process. In terms of Medical 7, at the moment, we are planning to have the channel over and above the platform we still will have the LLC route there as well. So Denise, I hope that answers your question. And then I see there's one more question that came in from Sue. Can the source account be a joint user account in Channel of Isles? My understanding is that that means that you are investing in your personal capacity, and you can list the destination account as a Channel of Isles account. So therefore, Sue, that's correct. You can do that. One of you have to be the actual investor. You can't actually invest in both names. So if you just make an agreement between you and your husband or whoever your partner is, then we can actually do that investment. But the point that I'm making is that it has to be from a single source. All right. So yeah, I think Billy, any last comments from your side?
No, I think you said it all. I think it's a great opportunity. I think there's a good growth at the end of the day, and I think it's well worth investigating to invest in.
Yeah, and I think from our side, this is really launching a new segment. Most of you have been pretty much used to us only talking about the medical industry, and we're also now introducing the multifamily. So I want to be 100% sure that our investors understand that we're expanding our exposure to the United States, and in both the medical space and the multifamily space, we are building a pipeline of deals. Matter of fact, the PPA group has another 3 coming our way. So if all goes well, we will continue that segment as we've been continuing with the medical segment. As you can see, we're already up at medical 7. Just that you know, we've got another 4 of them in the pipeline. So we actually have projected out almost for the next 6 months another 4 medical deals, and on the multifamily, most likely another 3 to 4. So as you can see, we try to have every quarter for you another investment opportunity. And so if you're not 100% ready this time, prepare yourself, and then when the next bus come along, please hop on board. So far, it's been a very good experience, and we've got a track record to prove it. And I think it just helps our investors to really diversify by virtue of Australia and America. And lastly, we also want to diversify in terms of commercial investment segments, having now 2 on the portal from an American perspective, and the 3rd one as a development perspective. Yeah, I think, Kevin, any specific other points that you wanted maybe just mention quickly?
Just quickly, before we do sign off, I wanted to let everyone know that there is the brochure is available in the handouts. So if you are interested, please do click on that, and you will then be able to take a look at that and read through it, and then make your way through to the portal the secure site, in order to get yourself signed up if you're not signed up, and then pledge your interest there. Thank you to all of those who have answered the polls that we've just put up at the end. These are really here so that we can ensure that we assist you best way possible. Other than that, I'd just like to thank Michiel and Willie for getting everything organized tonight and for letting us know what's happening. Of course, we are hosting another webinar, exactly the same webinar on the 27th. So if you do want to share this with others, if they want to come live on the webinar, they can do that. Other than that, we just want to say thank you very much to everyone for being online, and good night. And thanks, Willie.
Thank you, guys.
Cheerio. Bye-bye.
Goodbye. Good evening.
Arigato.